Welcome, everyone. I'd like to welcome everyone to the 2022 State of the Market. It is my honor to introduce to you your host tonight, the founder and CEO of Swan Capital, Andrew McNair.
Imagine you're writing a keepsake for your family, a diary, a journal that you hope to pass on maybe to your children, to your grandchildren, and you're thinking about what to write to make a lasting impact for them to learn from, to take the life lessons into their life, to their unexpected disturbances. After reading this book this weekend, it was perfect timing to read a book like this. Benjamin Roth was a bankruptcy attorney in the 20s, and he started the journal under the same pretexts, that he would write a journal for his family and so that they could know more about their father, but also know more about the times. And of course, the Roaring 20s was probably a great time to document about what was going on and the expansion in the country that was undergoing. But then one of his major entries was, "The market fell out today." And that was kind of an understatement. And what I loved about reading this book, and I highly recommend it, it was nice to see someone genuine, sincere, that said, "I don't know what the future holds." And to be so genuine to go back 10 years, 1 year, 3 years to each entry, multiple entries, and say, "Wow, I was completely wrong on that guess. Oh man, I was more right than I could have ever imagined." And it was a fascinating book. It was like taking a metaphorical additional walk with my own grandfather to hear the stories about the Great Depression, as well as the expansion of our country and the entrance into World War II. And so today, I'm going to talk about some predictions, and we're going to make some entries of what I think may happen. But there may be, 10 years from now where, man, that Andrew had no clue what he was talking about. That may happen tonight too. So tonight is our annual event, the State of the Market, which I am so excited every year that we do this event, because it allows us the time to reset our clocks, start off with a fresh year, and talk about where we've come, where we're potentially heading, and first, how did we even get here? And that's really what I'm going to cover. As you probably saw me go through this agenda, is we are going to talk about what happened in 2021, which we've talked a lot about at the halftime report if you were here. We're going to talk about what drove that market performance. We're going to zoom in. Then we're going to talk about where potentially I think we're headed. But I think the most important is the last part, is what can we do to affect our personal economy regardless of what the economy does. And I'm going to hopefully give you some tangible things of what to do. A couple formalities though, is that this is not personal financial advice to you. And how could it be? It can't be personal to you when there's hundreds of people listening online or listening here today. But I am going to give you some very important things that you need to know about what's going on. When it comes to questions, I know if you're thinking about this question, chances are someone else is too. And I do encourage you to write them down. We can handle them at next review if you want to handle it on a more personal basis. Or at the end of the talk tonight, I'm going to open it up for a few questions. So please do write that down, because if you're thinking about it, somebody else is too. A couple housekeeping. If you'll turn off, silence your phones if you haven't already, so that we can all pay attention, including me, because I'm pretty ADHD. So let's jump right in. How did we get here? How has the market performed so far? So as you can see on the big screen, there were huge milestones that happened through the S&P 500. We saw a 26% growth for the year, an outstanding year for the market, for investors. And when you look at these major milestones, what you can see is that the market, and we talked about the halftime report, shrugged off nearly every single one of these. We started off with the inauguration of Joe Biden, and I talked about in the state of the market, and I've talked about this multiple times, that a president does not make an economy, at least in the beginning. And that's why so many times people make, I think, very short-term decisions with long-term money on an event like an inauguration, and sometimes that can be misplaced ideas. The next is going to talk about this stimulus. That is what drove a lot of this growth. Is we were headed back on a strong recovery, but fueled by a lot of stimulus. With the rescue plan, you're looking at $1.9 trillion of stimulus. So tons of stimulus dollars have intersected the economy. Then the next milestones we talked about were supply chain logistics. And those really have been a reoccurring theme, not only in 2021, but probably will be a reoccurring theme in 2022. Is you saw with the Suez Canal, that was a major artery that was blocked by a ship, by a barge. So that was an issue, and we didn't even need shipping issues when that happened. So that affected oil prices between the travel between Asia as well as the Middle East. That nice channel was interrupted. Next, you saw with the pipeline hack, that didn't help gas prices when they were ransomed for literally millions of dollars worth of Bitcoin. That was an ordeal, and it also just made us all a little bit wiser how our infrastructure can be hacked, which is, again, if you had asked me 10 years ago, did I think our infrastructure would be hacked, I would have been very skeptical. Now it could happen any day, it seems. The market went on for a large run. And then Hurricane Ida, we all are familiar with Category 4 storms, what they do to, again, shipment, especially in New Orleans, as well as just costs of goods. We already had an issue with the cost of hardware prices with lumber, and so a hurricane doesn't help. But then we had the Delta variant as well as the Omicron variant, so you see a dip there. But also, the Omicron might be hiding some of the markets starting to slow down, even with all of that stimulus. As we went into the fourth quarter, there was not a lot of new positive news on the horizon. So the market is starting to slow down because what else is there is good news, in which I'm going to talk about what news is up ahead. If we went to the smartest analysts in the world, they make their estimates known, which is it is helpful to know. This was in State of the Market in 2021. I showed you this exact same slide, different color, showing you that every analyst, again, these Wall Street analysts have every tool known to them. They have teams, huge research economists and teams that are trying to supply them with the best information. They were estimating that the market would end at 4,100. They were optimistic it would be a positive year. Well, as you can see, they were very wrong with the market ending at, as you can see, 47.66. So a very strong finish that surprised many of the commentaries out there. So as we look at this recovery and zoom in, I want to show you some other recoveries over history. So this takes us back a little bit farther, but you can see how much of a run that we've had since the depths of February 2020. You can see we've had a 400% increase from the depths of the 2008 Great Recession all the way up to December of 2019. I said the market's at all-time highs. Can it go much higher? Then, like I said, I had no idea the black swan event of COVID was going to turn around the corner, but we were prepared. We were backpedaling. As you remember, I told all of you that we would be backpedaling in the portfolios to get prepared for a potential pullback. Again, had no idea it would be that bad. The market dropped 34%. Then a huge recovery. If you would have invested at just that period, That is 113% recovery from there. Again, way stronger than any analyst, way stronger than I would have ever imagined. That V-shaped recovery doesn't even look like a V. I mean, that is really lopsided. It looks like a check mark. So it's done fantastic. And the reason why, as we all know, is there's plenty of stimulus and plenty of tailwinds that are helping this recovery move forward. So as we continue, we have to start talking about overvaluation again. And this is where we were in 2019 going into the state of the market of 2020. Is, are we overvalued? And we use multiple measurements. Just to name a few, we use the Buffett index. The Buffett index compares the GDP and it compares the PE ratio. So price to earnings ratio is, if you were to buy the whole stock market, you can see that the stock market right now is selling at 34 times earnings. It was, a few weeks past, selling at 38 times earnings. To put that in perspective, that would mean a movie theater that makes $1 million would be selling for $38 million. Unless it's AMC theaters with meme stocks, that's not likely usually. Most people don't want to pay that much. It's expensive. Now you can see, again, and you've heard me say this in individual reviews, the S&P 500, once it gets above 25 to 30, we are starting to get into speculative territory. Because when Benjamin Roth was writing his diary journal of the Great Recession, it was a 29-30 before the market fell out, as he said. And here we are. The only other time we've been this high before is the dot-com crash, and that ended poorly. So you can see the red dot. That's what many of y'all are asking. Andrew, what do you think about last week? What do you think about today? Well, these are great questions. The problem is like anyone, if they tell you they know, they don't, is this could be the start of a storm that's going to blow over, be volatile, because many times throughout the year we're going to have volatility. That's going to happen. Even in stellar years, we usually have volatility. Last year was a very rare year where we didn't have very little volatility at all, and the market went straight up. That's not usual. You shouldn't get used to that. So this is either going to be a blowover storm, or it is the start of a resetting of valuation. And I'm going to talk about how we're prepared for that. But as you can tell right now, it's just too early to call. It's only a week and a half into this. But we are overvalued. And again, the mistake that people can make is they think, aha, I will outsmart the market by looking backwards. That turns into comparing skill and luck. You'll probably not get it right most of the time, because as you can see, the dot-com crash went up, and then people said, I think it's going to sell off, and then it went up and went up. And you don't want to be on that treadmill of jumping back and forth on the stock market's tails. So this is a very interesting graph, and I think it needs to be brought up, especially after talking about the overvaluation of the stock market here domestically, is talking about our outperformance of international markets. As you can see, this graph compares the international market compared to our own. In purple is the international market. Here we are domestically in gray. We've had a strong S&P 500 for the last 14 years. Now again, the S&P 500 is made up of 500 large U.S. companies. So not all companies have experienced that boom here domestically, just the large ones have. And I would even say, and I'm going to talk about this a little bit more, is that really about 7 companies, Facebook, Tesla, Google, Amazon, just to name a few, had most of those gains. 25% of the gains over the last 3 to 4 years have been, only the majority have been from those 7 companies. So it is a very misleading graph. But what I can tell you is that purple will come back. There are other markets that are just as trying to be as capitalistic and competitive as we are. Just a different view of their capitalism, of course. I'm going to need a drink eventually, Ashley. What's driving this market performance? There's so many different tailwinds and headwinds that can affect a stock market. And you've seen this graph before. We call it the speedometers. And these are supposed to be 6 months forward. And you can see in January 2021, not everything was figured out yet, how fast this recovery would be. It was still a V-shaped recovery at that point. It had not turned into the check mark. And as you can see, we still had geopolitical risk. We had stock market valuation was still a problem, but we still didn't have the full support of all of these other metrics, like the labor market still hadn't come down to all-time lows again. So we still had a lot of things to figure out in 2021. Fast forward to 2022, we are operating on all cylinders. That we can't ask for much more than what's already here. Sure, the market is overvalued. That is a big concern of mine. But one other concern that you should notice is reading in between the lines. And I talked about this at the halftime report. Interest rates are super low. That's why it's at full throttle. So is monetary policy, fiscal policy. When all of those are full speed ahead, of course, it affects eventually all of these. When easy money is easy to get to, as a business, of course you can hire more people and you can raise wages. But there's not much more good news coming after seeing these 6 months looking forward charts. So one of the things that drives our economy the most is consumer spending. As you can see, this is the frequency data for airlines, for restaurants. You can see the huge cliff dive that happened down here in 2020, where we went from literally all the restaurants closed, couldn't seat anyone in a restaurant, to now we're actually about 4% behind where we used to be. So thank you so much, Ashley. So we have come a long distance. You can see when it felt like almost 9/11, where the skies were empty and there was no planes. But look at where we are now. We've come a long way. 70% of our economy is based on that spending. So if we are operating on full cylinders, which everyone is now back to their good old American way of spending everything we make, then that's going to be great as long as consumer confidence stays high, which right now it's doing quite well. The other thing we want to look at is the low employment. We've been very blessed with low employment. If you want a job, you pretty much can get one. It is stubbornly high. 10 million jobs are available that are not being taken advantage of. So we are at, I wouldn't say maximum employment, but we're at very healthy employment right here. So again, operating on full cylinders, and as long as that stays there, that's going to be fantastic. When people have money because they have reoccurring income from their job, of course they're going to spend it, and that drives our economy. Now, the question is, but where are we headed? And I'm hoping to answer that. If you ask the smartest people in finance, this is their conclusion. This is their estimate. If they look at the end of 2021, they're expecting a healthy increase again for 2022. So all the analysts but one estimate that we're going to have a positive year. Only but Morgan Stanley's out there waving the flag that we won't. If you're summarizing what Andrew thinks for 2022, we are going to have volatility. After coming off a super strong, smooth year of solid 26% uptick in the S&P 500, we are going to have volatility, and I do think it's here to stay. And I think that's going to present some buying opportunities. Now, how deep those cuts are going to be, again, I don't know if it's a storm or if it's a hurricane, but we do have some cuts that are going to have to be made in evaluations of the S&P 500. Speaking of evaluation, I think you're going to see higher valuation spreads until we finally have a major pullback. This is a very interesting chart, so I want to spend some time explaining it. This shows you, going back to mid-1990s, how expensive the S&P 500 companies can be and how cheap the S&P 500 can be. So, for example, how expensive Amazon can be, selling at maybe 40, 50 times what they make, versus eBay that may be only selling at 8 times what they make. There's this huge dispersion. And as you can see, that dispersion starts to come down drastically, typically when there's a major pullback. So like I started, we look at the Shiller PE ratio, we look at the Buffett index, and we look at this S&P 500 dispersion chart to determine if the market's overvalued. Well, we know the Buffett index is way overvalued. We know the Shiller PE is overvalued. And then we look at this S&P dispersion. We have to ask really 2 questions. Because you can read this 2 ways. Either there's a lot of deals out there right now that we can buy on the S&P 500, or the market is drastically overvalued. And I lean towards the latter is the case. The S&P is overvalued. When you have companies that are selling at hundreds of times, I'm not saying Tesla is not a great company to buy, but when you have a company like that that's selling at hundreds of times what they make, that is a concern. And it's historically, as you can see, doesn't happen very often. And it usually has bad consequences. So when I was reading Benjamin Roth's diary in his journal, he said these words. I'm paraphrasing. He says, "I don't think the government can continue at this pace to go into debt at their pace." And I wrote, "You have no idea." He said, leaving President Hoover's Republican strategies of hoping that the average American can just figure it out, going to the complete opposite, FDR's New Deal, which sounded very attractive to 1/4 the population being unemployed. He said these socialistic agendas, of course they sound enticing to a person that's out of work and number 400 in the soup kitchen line. He said, of course, they sound very enticing. And he says, I don't think this is going to stop. And it didn't. And we all know from our history classes that FDR and his administration kept on adding program after program and program. And some give him the benefit of saving us from the Great Depression. But something else also potentially did too. He said, Benjamin Roth, I don't think that we can continue spending this amount of money without going broke or having, again, lots of consequences, i.e. inflation. But then he came back in like 1956, and he was genuine and he was sincere. He said, I just had no clue that World War II was coming. And that is very alarming when you see a chart like this. I think if we're not careful, we're going to see higher debt going into 2022 and beyond. And what you can see is what Benjamin Roth would, turn over in his grave to see is that in the height of World War II, where the whole world's at war, we had percentage to GDP of debt levels today. And COVID may feel like a battleground, but it was not World War II, that by any means. So that is an alarming graph. And again, we all may be like Benjamin Roth. I think this can't go on forever, and it does. But this, I do not believe, can continue going on without something to change. And as you can see, the only way we've got out of this deal before is because we outgrew ourselves out of the national debt with a baby boom. And if you check with your kids, are they plan on having another child? The answer is no, and we'll let you know. So I don't think a baby boom is going to get us out of this one. So we're going to have really big steps in innovation to get us out of here, like the Jetsons kind of innovation, or some other event that I'm not aware of. Hopefully not a war. So what else can we expect in 2022? Higher inflation. You've heard me say it in the halftime report. I made it very vivid, talking about the gas embargo and the lines that we had in the 70s and the 80s. That inflation does not go into the darkness from the light very easily. And that the Fed believed that this inflation would be different, that it would be transitory and temporary. And I made the case to you in our monthly market recaps that even if it was transitory, that some of the damage has already been done. When prices are raised double digits, people, and they know that the consumers, us, can pay it, they're never going to give back all of those gains. They're going to say, great, we raised prices and this was a great opportunity. And you can see that with used cars going up 24%. I've never been one to quickly to tell people to go out and buy a brand new car over a used car. Of course, frugally, usually it makes sense to buy a used car. Not today in this upside down economy where 24% increase in automobiles. And we've seen that in other items like food and eggs and gas, things that we use on a regular basis. And we're up anywhere, depending on if you strip out oil or if you strip out various things, CPI, somewhere between 7 and 9% year over year inflation. And that, again, if it lasts long enough, has disastrous effects, not only for the poor, but also, more importantly, for retirees, people that are on fixed income. So again, to hit this point home, we haven't seen this kind of inflation in nearly 40 years. And it is something to keep a serious eye on and also to play offense against. And I'm going to talk about how do we do that. But as you can see, record inflation, and we're breaking the records that we don't want to be breaking. The other thing we can expect going higher is higher interest rates. I have been very negative towards the Fed. Now I'm armchair quarterbacking the Fed, and I'm glad they have the job and not me. It is a very thankless job to be Jerome Powell, but I will say that they've been $1 short and a day late with making hard decisions. I told you in 2019 and going into the state of the market in 2020 that they should be raising interest rates, not lowering them. And what did they do? Trump and that administration did want lower interest rates. And going into COVID, we potentially needed to not increase interest rates, but we've missed our chance. With 120, 112, 113% increase in the S&P 500, they should have been raising interest rates. And now they're going to have to make knee-jerk reactions. They're talking about 4 interest rate hikes in 2022. And if the Fed does not decide, the market will decide. The Fed does not have to have meetings to decide on raising interest rates. They can do it without the Fed, without any meetings at all. So we need to keep an eye on higher interest rates, because once this easy money starts to become harder to get to, it makes the stock market not so attractive. See, right now people are on this big chasm. They're separated between super low interest rates, or they're having to take additional risk that they may not even be prepared for, called the stock market, to keep pace with inflation. So higher interest rates are something to definitely keep a close eye on. The next thing is higher taxes. No surprise there. It has been talked about repeatedly about increasing tax rates. They even talked about doing it last year, but with so much happening with COVID and the Omicron and the Delta variant, I mean, that administration was laughed at about raising taxes. Well, 2022 is a new year. Even if we have a market pullback, they're going to talk about raising taxes. That is going to be on the agenda. And they have had some crazy proposals from both aisles talking about getting rid of step-up and basis, stopping Roth conversions and contributions for different income limits. They're talking about raising taxes on only the rich and people that have high incomes. Again, I would be looking at history, and we know that the current administration has been in power before, and they've had higher tax rates. So we have to play offensive on getting ahead of these tax rate changes. And then higher geopolitical risk. All of these are culprits. They like to throw missiles in places they don't belong, and they like to try to invade places they shouldn't be either. And so any of these could be a major curveball and add geopolitical risk that was a yellow right into the red line overnight. I mean, this video, this presentation tonight could be outdated by tomorrow. So we're keeping an eye out on a lot of those higher taxes, higher interest rates, higher inflation, and higher geopolitical risk. It is a lot out there to keep an eye on. So what strategies have we implemented, and what can you do to stay ahead of it? So right here with our SWAN portfolios, I think that's some of the great defense and offensive plays that we're making right now. First off is that our portfolios are not the S&P 500. The S&P 500 may post a great year of 26%, but it is made up of the S&P 500, which is 500 large U.S. companies. All of our portfolios have large, medium-sized, small, international, as well as real estate blended into those portfolios. So you are more diversified. And I'm going to talk about the power of diversification in just a second. The other thing is we're not keeping these static. We are making rebalancing moves to try to stay ahead. We, again, finished out all of our energy positions. The energy prices got worse, but we did lock in a really nice position and profit. Next thing we looked at, if I can read that small print, is we lowered our exposure to long-term bonds. And we shifted to short-term as well as TIPS, which are connected to the inflation of CPI, which really protects us on our safe parts of our portfolio. Third, we added more diversification to our dividend portfolio. We want to have in our dividend portfolio preferred share income. We wanted to have real estate. We wanted to have bonds. We wanted to have international bonds and securities producing those dividends. We wanted dividends coming from all sources, not just one company. So why does diversification matter this much? Well, it's the only free lunch that exists. As you can see between these two graphs, is if you have 4 things making up a portfolio versus 8, it allows us to have a better return or the same return with the same amount of risk. And that is a free lunch. And that's what we've done with our portfolios, and we'll continue striving to do, is adding that diversification to get that free lunch that's out there. Which means, no, your portfolio won't go up the same way the market will. But if we give it enough time, 3, 5, 10 years, it should, again, follow along step with the market, but in a different way. The other thing that we work on, as you know, with clients is a spending hierarchy. When you retire and you go into retirement, on a Friday you retire and you walk into a Monday, a retirement of keeping your pajamas on and not going into work, we have to ask ourselves, where does the money come from? And so that's why we segment your money. And a part of each of your financial plans, and that's what's so unique to where you sit here today, is a lot of people potentially who are listening right now via live have maybe statements, they have a portfolio, but you have an income plan. And we know which buckets we're going to take from first. So what we segment for each one of you is the first 5 years to be covered. Because you've had me tell you, you need to go into retirement with your foot on the pedal. We all know that life is short at its longest, that we need to enjoy our retirement. And the last thing you want to do is pedal to the metal, like Andrew says, and then a market hiccup happens like last week and today, and you're thinking, do I still take the vacation? Do I still take the cruise? No, you take the cruise, because we have your incomes through year 1 through 5 mapped out. We don't have to worry about where the money is going to come from, even if the market is down. Then we have a bucket, number 2, that has your income from years 5 to 10. Years 5 through 10, that money may be more locked up, may not be more liquid, which gives us a permission slip for 5 years to take more risk. And then the last bucket is our offensive front against inflation. That's why even some of you listening may say, Andrew, I don't have a lot in the stock market. That's why we have that third bucket for you, is to have at least something in the market that's fighting against inflation, that we gave it a job description to go for 10 years and not come back. And that gives us that fighting power, because we've matched your investment horizon with your retirement horizon. The other thing we've done, if we see higher taxes because of an inflated national debt, as clients of Swan Capital, working alongside your CPA and bringing in CPAs to the planning that we're doing, we're giving you tax advice alongside these tax professionals to make sure that you're ahead of the curve. You're just now hearing people, or at least I am, my colleagues, talking about Roth conversions or qualified charitable distributions to your church out of your IRA. And many of you already have been doing that. You're ahead of the curve. For you that are 3-5 years out from retirement or only 1 year of retirement, you've heard me talk about putting money to HSAs, putting money to your Roth TSP, putting money to your Roth 401k, because we want to start putting money into tax-free investments so that if we see a period of higher taxes that lasts 5 years, you'll be able to stomach the winter of higher taxes. And that's because we have your money tax diversified. The other thing I want to talk about is incorporating market hedges. Most likely, none of you have all of your money in just bonds and stocks. We've incorporated alternative investments. And you saw me show you this graph in the halftime report, but it's worth repeating again. So if you look here at the top, you can see that the S&P 500 companies have had a great run. Historically, actually, small company stocks will outperform the S&P 500. It just hasn't lately. The last decade has been like Alabama football. They've won a lot and haven't lost as many. So that time will switch again. I do believe small cap will have its heyday again. But what do a lot of your friends that you golf with, they talk about? Hey, I'm pretty protected because I have bonds in my portfolio. Well, bonds technically can lose money when the market loses money. So if you look at a traditional 60-40 bonds to stock portfolio, you made an 8% return over the last 10 years. However, with extra time spent explaining things like index CDs, puts and options, index annuities, you can see that we've actually, and many other investors with this strategy, have actually seen less risk and a higher return in the long haul. And that's what we want to continue to see. And that's why we seek after alternative investments. We don't just pull one rock up and say, I think we've seen them all. No, we continue to look for better alternative investments. The next thing that you can do is invest your cash. There is going to be buying opportunities going forward. There always is. And typically in any market, even down or a market that ends up, there is 10 to 20% market pullbacks within a given year in the stock market. So if you have cash that you thought you were going to spend for a renovation, you thought you were going to spend somewhere else, and we see major pullbacks, that's a good time to say, hey, Andrew, via email or a phone call, I have some more money I think we can invest. The market looks really ugly. That's a great conversation to have because you're buying. And oftentimes you need to remember that the market's at its safest when it's down 20 or 30%. It's not at its riskiest, it's at its safest when it's down 30%. So you can see this is an account at $100,000 invested in 1996. If you were making a 5 to 6% return on your savings account, you were keeping pace with inflation. As you can see with the blue line right here, that's how much interest you need to beat inflation. It's a very fancy graph. I love this graph. But fast forward to where we are today. If you have $100,000 sitting in a money market, sitting in a checking account, a savings account that's above the emergency savings that you need, this is how much you're making, $70. And you don't even get a toaster anymore. It's tough. And so if you need $4,000 to keep pace with inflation, and we're making $70, we're in a real bind. That's why we do need to look at alternative investments or putting some of that cash into the market as we have market hiccups, which they will come. So action items for you. First thing is that I want to talk about is making sure that you keep us up to date when your life changes. If you need to make life changes to your estate planning documents, we need to get you in to have a meeting with Scott. If a renovation became a want to till I've been locked up in my house this whole time, it became a have to, We need to get you back in the office for a review to update the plan. Maybe your income needs have changed. We need to know about that. I'm encouraging you to spend more money because, again, many of you have the money to spare, and you should do this. And if you, like my old joke, you've heard me say it, if y'all don't start flying, your kids are going to be flying first class. So y'all need to enjoy it. But I need to know about that because that does play into the income plan. And I can tell you, hey, those estimates are a little too high. Maybe you've gone a little too overboard. But y'all do need to brush off the bucket list. I have time for just a few questions. Many of you, again, we can't get to all of your questions. So that's why an email, bring it up at next review. I want to make sure you get an answer to your question. But who wants to start us off with a question? Go ahead.
You were discussing in the employment thing how positive the employment was, and yet we have so many jobs out there that are not being filled that are part of the backbone of the economy and part of the backbone of the operations of the country, and people aren't wanting to fill these jobs. And so I'm having trouble seeing a positive perspective on the employment.
Yes, his question is about how is it a positive situation with all these millions of jobs. I think what you're seeing is potential. There's everyone's best guess because it's still writing itself. History here is 2008. There was a lot of people that said, "Hey, I'm unemployed. I think I'm going to start a business." So we have seen some increase in new business ventures, which a lot of those do fail. So they'll be back into the workforce. They haven't figured out that they are a worse boss than their last boss. So that may fix itself. There's a lot of people that still had some stimulus money that I think had to spend through it. I also think that there has been a slight recalibration. You're seeing this with a lot of millennials and younger that don't want to work as much because they're worried that they could potentially die early. So maybe COVID has woken up to them that they actually could die and they weren't thinking about that before. There's a lot of speculation there, but there's definitely a huge need. I also think that, I don't know, I'm speaking now, I'm going off of my own opinions, is that I also think we need to see a resurgence of people like Mike Rowe promote trade schools so much stronger. I think a lot of people think that I have to get my job, I have to have a bachelor's degree, I have to have a doctorate. Not the case. I mean, when I'm getting quotes to tile my house at $7 per square foot for labor, that signifies a problem when it was only $2 a square foot a few years ago. So we have a problem. So when you can make $7,000 in 2 days with no diploma, not even a high school one, that is alarming. Other questions? That cannot be the only question. Okay, it is. All right. One more question.
Can you tell us a little bit more about the Signet and how that hedge fund is going to work?
Yes, I can. Now, again, don't throw tomatoes at me. It's not my fault. Some of these rules I'm about to say, I don't make the rules. You have to be, there's different rules of being an accredited investor. And that means that you have to make a certain income, $250,000 or more, or you have to have $1 million of net worth excluding your home. So if you say, that's not me, Andrew, no hard feelings. I just can't offer that. You already do have some real estate in the Swan portfolios, so don't feel like you're being completely left out. But the Signet fund will be for accredited investors that have over $1 million of investable assets. And it'll be somewhere in the minimum $100,000. We're teaming up with some really smart people that have property management companies that are local, which I love, is having someone local. I'm not going to throw out any names because nothing's official, but you would know these names. They're local names that we all know in the real estate commercial space. And so we're going to work alongside them, vet opportunities, and then invest in those, again, with pooled resources that we otherwise could not. When you can come to the table with $5 million in cash, you can buy what people can't, because they have to go get bank financing, take them 90 days, and we have $5 million in cash. And that provides us, we're buying something that's anchored, like a triple net lease. I'll give you a prime example is, and they just built one where I grew up in Cantonment, is one of these urgent care centers. So that's someone that we would build the building or fix up the building, make it an urgent care center, for example, and then someone would be a 10-year or 20-year lease. and that leasee would be West Florida Hospital, which most likely shouldn't go under. So those are great opportunities because you're not responsible to clean the toilets. They are. They're probably not going to go out of business. So they're very good residuals. So it's as much as I'd like to talk about at this time, but thank you. That's a fantastic question. It's going to take me a while to hammer out all those details. So this year is my agenda to do that. Other questions? Yes, sir.
I want to ask about health insurance. That seems to eat up a lot of your retirement. Do you have any recommendations? Some of these are, thousands of dollars a month for an individual.
No, I think that's a fantastic question. Health insurance. I think your friends are asking it, especially if you're retiring or just retired, you're worried about health insurance. This is where in reviews that we're talking or with new potential clients, we're talking to them about making sure they have some of that tax diversified money because they're going to have to go to the marketplace. Well, if all your money's in a 403B, a 457, an IRA, that pushes you over that marketplace income limits. So then the marketplace is too expensive. Some people are having to do COBRA. It's a case-by-case basis. Also, we are looking at the spouse's insurance. Sometimes they have better insurances. But sadly, I think it's the biggest determination right now between someone retiring early and not is health insurance. And until they reach 65, Medicare is something that's a lot more reasonable, obviously because it's government managed and subsidized in some ways. We all paid into it. It's not truly a subsidy. But like Medicare being 147 plus in a Medicare premium with a Medicare supplement, now you're at $350 a month. That's a lot more doable than I agree when you're looking at $1,500 or more potentially for health insurance. So I can't solve that problem. It's a case-by-case basis. But I think tax diversification is really important because for some families, they're going to have to do the marketplace. We do have a contact if you have questions about health insurance. Scarlett Hammerbacher, say that 3 times fast. This is not on video, so it's luckily not as much pressure. But Scarlett is awesome. She can help you with health insurance. What I help families do is the Medicare supplements. So when you do get to 65 and you've got Medicare Part B, we can help you decide between an Advantage plan and a supplement. And they are different. If you're on a Medicare Advantage plan tonight, oftentimes you think, everything's been going great, Andrew. I've been healthy. I don't pay anything out of pocket typically for a Medicare Advantage plan. Everything's covered like with my vision, my dental. But when you start having health problems, you might have a really rude awakening because you may be on the hook for a percentage of those surgeries. And so that's where we start to look at if your health is changing. I wouldn't say it's getting worse, but it's changing. We need to look at a Medicare supplement. A Medicare supplement, again, is just that. You pay your Medicare Part B and you pay a supplemental price above that Medicare Part B premiums, and that collection covers 99% of everything you're going to run into health-wise. So thank you for that question. Any other questions? I think that's it. Well, I thank you so much for your time. I thank you for the trust that you put into Swan Capital and the team. I mean, it is a heavy burden, and we're going to be diligent. I can assure you one thing, that we will be diligent of looking for opportunities to put some of the cash that's maybe in your portfolio to work, to take educated, calculated risk when the time presents itself. If this becomes a hurricane, we will run into that storm. And that's the same thing that we did in March of 2020. Y'all remember, I sent you all a phone call and it said, if you're, I'm going to start buying stocks with your bond money. And if you have a concern, call me quick. That's what I did. And no one called because we all know that that's a part of the plan. And many of you are sitting where you used to have 100% in Swan Balanced. And when the market dropped, we were able to move 30% of your portfolio from Swan Balance to Swan Growth, and you ran into that storm. And many of you know that went through it like that, paid huge dividends by having 30% in Swan Growth. And so the analogy that I give is, think of the portfolio as a 4-speed transmission. When the storm comes, we want to run into the storm, and that means going from gear number 2 to 3 and 3 to 4. And that means slowly, 10% a week if we have market hiccups. So Again, thank you for that trust. And again, I look forward to seeing y'all at the halftime report next time. Y'all are very kind, very kind.